Hello and welcome. You've tuned into Business Lunch. I'm Nisha Podar, and with me, as always, is my co-anchor Pavitra Parekh. Pavitra, good afternoon. And the big news of the day is Twitter being bought over by Elon Musk, and it has created just so much frenzy in the Twitter world, and that really continues. That excitement really continues.
Ever since yesterday, right, with him walking in with the sink.
Oh, that was a sinking feeling, I must say. All right, so that excitement really continues. We'll focus on that news later, but first a look at our market, how the market is going to end for this particular week, as November is also going to start from next week in terms of trading. At the moment, Nifty 50 close to the low point of the day. It is finding it difficult to break above that 17,800 level. So 17,750 odd levels is where it is mostly trending at. And at the lower point of the day, in fact, we have to see whether it's a trend reversal from here on, where lunchtime is a lot of times a trend reversal time for the markets, and it's almost on the flat line, whether it turns into the red. A lot of that will really come in from the other pockets of the market as well. Bank Nifty down 1%. It is leading the charge. A lot of global cues have been really giving nervousness to the market, almost 1% down on Bank Nifty. And when it comes to the mid-cap universe, that is also showing a huge underperformance to the key indices at the moment, 0.6% down, but not the worst pocket because banks are really taking a lead on that. But as far as market strength is concerned, that is weaker and in favor of the declines today. Metals, remember, were shining in trade yesterday, and today they are seeing a huge amount of profit taking and a sell-off as well, Pavitra.
Oh, absolutely. And, you know, it is overall quite a quiet day, but just spare a moment for what's going on across the Asian markets. Hong Kong is down for over 4% right now. This is the lowest level that we've seen since 2009. So definitely keep that market on your radar. It's an over 600-point cut. By the way, the Dow futures have also slipped quite significantly, around 140 points in the red right now. But from the top of the session, it's down around 250 points. So do keep that on your radar. For our own markets, it is quiet, but there is a lot of action beneath the surface. So while the index looks quite muted, some of these auto names are moving ahead of Maruti's results today. So that pack is in focus. You also have some of the PSU stocks which are holding up quite well. On the downside, it is the metal index which is seeing some cuts. But remember, this is, of course, after, you know, the sharp rally that we had yesterday. So par for the course there, but it is a 2% cut that we're seeing on the metal index. There's a lot of action in some of these smaller names, the likes of SBI Card, Tata Chemicals. We'll talk about that in some more detail. But today could be a lot about these individual stocks because some big earnings are also lined up. So Maruti, like I mentioned, you have Dr. Reddy, you have Bandhan Bank, Vedanta. So watch out for all of those. But let's get into all of these now. SBI Card is one that we're tracking. It slipped after net interest margin, disappointed. And also revolver rate has declined this time around. So Abhishek is here with the earnings fine print. Abhishek.
As you mentioned, the revolver rate or the loans which actually become due and starts earning interest for the company has actually reduced from Q1 FY21 levels of 45% to right now about 24% as of Q2 FY23. So what this has meant is that even the yield has declined from 22.8% back in Q1 FY21 to right now about 15.1% in Q2 FY23. This has had the impact on net interest margin as well, which has declined from 19.2% in Q1 FY21 to right now about 12.3% as of Q2 FY23. Credit cost that continues to remain elevated at about 5.6% in terms of annualized credit cost when compared to 5% in the previous quarter. Asset quality has seen some improvement, 10 basis point decline in the gross NPA ratio on a sequential basis. Total income is up 28% YOY and about 5.8% sequentially. They have reported a PAT of about 526 crore. Motilal Oswal Securities was working with a number of 590 crores. So brokerages, they have cut EPS anywhere between 1% to 17% for FY23 and anywhere between 2% to 14% for FY24. Higher than expected credit cost is a negative surprise, and the revolver book decline which continues is also negative for the company. So JP Morgan has downgraded the stock to neutral, and they have cut their target price by as much as 24%. So the new range of target price from brokerages is as low as ₹700 per share to as high as 1,175 per share. Back to you.
All right, thanks so much, Abhishek, for giving us a detailed analysis on SBI Cards. And that stock is down over 5.5% in trade today. The street has been punishing that particular counter, also because of negative surprise in the credit cost for the company. Next is also Tata Chemicals on our radar, and that is also down about 4.5% in trade after the company reported 40% growth in the revenues, even as the margins missed the street expectations. The street has chosen to look at the margins, and Sonal gets us the fine print of those performance and the details. Sonal, tell us.
Thanks a lot for that. Well, Tata Chemicals, it was a margin miss that was reported this time around. Revenue growth of 40%, EBITDA growth came in at 84%, but margins, though they expanded on a YOY basis, were lower than estimates of 24.2%. Profits also higher, led by higher other income and lower other expenses. Both the segments did well, but in basic chemicals, we saw a margin decline on a quarter-on-quarter basis, close to 510 basis points. There was some impact on volumes because of maintenance shutdowns. In specialty chemicals, margins increased both on a quarter-on-quarter and on a YOY basis. The management just conducted a conference call at 12 p.m. and they said that there is favorable demand-supply dynamic and soda ash markets globally are remaining tight, so they do not see any softening of soda ash prices further. Volumes, as I said, were impacted this time around because of some maintenance shutdowns. And if we talk about the geographical breakup, UK and Kenya, they saw one-time benefit in Q2 because of which margins were higher. This will continue in Q3 as well. And after that one-time impact goes away, margins will start to come back to normalized levels. They will remain range-bound for the company. However, margins in other geographies like US and India will sustain. Q4 of FY23 will see some price change for the company as contracts expire and go for renewal, and they also continue to see improvement in export pricing. European gas prices has been a big pain point for this company because they have a substantial exposure there. That has started coming down a little bit, so they are able to manage those costs as of now. So positive commentary, but still the stock had run up so much and there is a small margin miss. That is something which is not going so well with the street.
Oh, absolutely. Sonal, thanks a lot for getting us all of those earnings highlights as well as what the management has to say. But with that, let's move on and talk about Gokaldas Exports, because that stock is over 5% in the green after the company reported a profit growth of 60% in what is a seasonally weak quarter. Now, the company, in fact, also has capacity expansion plans of around 100 crores. This is for the second half of this financial year. Earlier today, we caught up with Siva Ramakrishnan, who is MD at Gokaldas Exports, and asked him about the company's capex strategy and what the plans for their business look like going forward. Listen in.
Q3 is going to be a quarter to watch. Globally, there is a lot of things going on. There are headwinds in Europe, headwinds in US, and headwinds in China as well, where retail sales is not so great. We are building the capacity in anticipation of certain orders. Obviously, if the growth exceeds our expectation, we will not shy away from putting in more capacity.
All right, let's shift focus to Nykaa, one of those digital companies which listed in that season of listings that we saw with Policy Bazaar, Paytm, Nykaa all listing in a matter of a few months, and almost 5% down in trade today as the stock is slumping ahead of the ending of the one-year lock-in period for the pre-IPO investors early next month. Also, we are expecting the results coming in. A lot of also details have been brought up in terms of the expansion as well as some of the management changes. So Manglam is here with all the details on what's putting pressure on this particular counter. Manglam.
There are a bunch of reasons why Nykaa is under pressure in today's trading session. And why just today's trading session? In fact, from its post-listing high, the stock has actually corrected over 60-odd%. And it's, fallen below the IPO price of 11.25 as well. And now it's lower by almost 12 to 13% as against its IPO price of 11.25. Now, there are three reasons. The first one, like you pointed out, early next month, November 8th, 9th, we have the lock-in for those who were allotted shares pre-IPO, which ends. So, as per their red herring prospectus, almost 47 crore shares or 98.5% of the company's equity was allotted pre-IPO. Now, Of that, 52.37% is promoters holding. Part of promoters holding also gets freed up, but assuming that promoters aren't rushing to the exit door, that still leaves about 46% of the company's equity, or nearly 21.8 crore shares, which are eligible to be sold. So the street is worried about the kind of supply coming in post this lock-in ends on November 8th and 9th. The second part is the replacement of the CTO. We understand that Rajesh Uppalapati has been appointed as CTO in place of Sanjay Suri. Now, Sanjay Suri has been an old hand, was with the company since 2016 itself. So it'll be interesting to see what has happened out here, because Rajesh Uppalapati, as far as his credentials are concerned, has been with Amazon for almost 2 decades. So no problems with the credentials. The reasons are important, and we've seen a few other senior level exits as well. The third most important reason, that the company reports its results next week, the second quarter results. And if deliveries update is something to go by, we've seen that, the second quarter is no different from the first quarter. So maybe the street wants to give it some time before they look at the third quarter and then take a fresh look at this stock.
All right, Mangalam, thanks a lot for getting us all of those.
Yes, so we were thanking Mangalam for putting that across. But remember, the two other counters are going to be Policy Bazaar as well as Paytm, and both of them substantially lower than their IPO price. So it will be very, very interesting to see with global pressure also building on these kind of companies, Pavitra.
Oh, absolutely. And the earnings are also right around the corner, right? So not too much longer before we do hear from the management as well. But with that, let's move on and talk about the FMCG space, because sales data for the month of October is out, and it looks like the festivities have boosted sales, with chocolates and confectionery segments leading the charge. Shilpa is here to tell us more. Shilpa, is the Diwali cheer back?
Well, it seems like the Diwali cheer is back. So we're looking at Bizom's data from the 1st to the 24th of October, which is up to Diwali. So in the run-up to Diwali, the sales seem to have picked up much in line with the expectations of FMCG companies. Now, FMCG sales were about 5.6% up month on month in the first 24 days compared to the corresponding period last month. And for the Diwali week, which is the 18th to 24th of October, their sales were up about 10.6% compared to the Diwali week last year. And on a year-on-year basis also, from the 1st to the 24th, Diwali sales, so FMCG sales were up about 5.2% year-on-year, and this is in comparison to September, where we had seen a month-on-month decline in FMCG sales. Now, let me give you a breakdown of the categories also. Like you said, commodities, chocolates, confectionery, that is what has led growth, with a lot of families, households buying a lot of oil, pulses, chocolates, sweets ahead of the festivities, and that is what really led growth. But there is still some pressure in packaged foods, home care. There's also a lot of pressure in personal care sales also, which were down nearly 17.5% compared to the last month, and beverage is also over 23% down month on month. But remember, this is because this is typically off season for the beverage sales as well. Now, the rise in consumption obviously was led by a lot of consumption of sweets, savories, gifting, which is obviously led by the festive season. Non-food discretionary, Bizom says, is still under pressure. This is despite the festive season. Now, in the urban areas, there was some revenge festivities that was seen despite inflation headwinds that really showed up the FMCG sales, but the pressure continues in rural, which is still growing or rather lagging behind urban growth. And this is what we've also seen commentary coming from FMCG companies also, that there is some pickup in the festive season, but mostly in urban. Pressure still continues in rural areas. Back to you.
All right. Thanks so much, Shilpa, for giving us this picture. So urban spending there, rural, there is a pressure, and non-food discretionaries also not seen that kind of a pickup which we expect in the festive season. A lot of that is to do with also inflation and also the central bank theme that is playing out across the country. So we'll slip into a short breather, but when we return, we'll focus on the Reserve Bank of India, the European Central Bank, and the Bank of Japan are all in news, and we get you quick central bank roundup after this very short break. Stay tuned.
Hey guys, welcome back. You're still tuned into Business Lunch. Now, the RBI has called an unscheduled meeting of the Monetary Policy Committee on the 3rd of November. So Lata is here to take us through what this really is for. Lata, we know that this is not to discuss rate action, but tell us what we should expect.
Well, the most important thing for the bond market to realize is that this is not meant to discuss any unscheduled rate hike. the market is still living in the fear of that last May when there, this May when there was an unscheduled rate hike by Reserve Bank. This is not on those lines because the Reserve Bank announcement, it's a one-word press release, one-line press release, which clearly says that this meeting has been called under Section 45ZN of the Reserve Bank Act. Now, this section itself got included only in 2016 when the MPC as an institution was set up. And what it says is, the section of 45ZN, it says that if the RBI fails to meet inflation target, it should send a report to government. 1, to explain the reasons for the failure. 2, to give remedial action, suggest remedial action. And 3, the date by which inflation will be brought down to the mandated level because of these remedial actions. So that's the report. Now, do you notice the dichotomy? The MPC takes the action, but the bank has to write the note. So obviously, RBI can't write the note suo moto. It calls the MPC members, discusses with them, and then drafts the note. That's why this meeting has been called. My sense is that it will be an uneventful day because the RBI governor has already told us RBI will not put that note in public domain. They will send it to government. It's a privileged note. Government may choose to make it public. So my own sense is there is no drama from Mint Street on that day. Whatever happens, we will know as and when the government puts it out in the public domain. If that happens at the end of day or the next day or the next week, we will get to know. But November 3rd will be a normal day. There are some people in the market who are trying to push up bond yields on the ground that, there is an unscheduled rate meeting. I think that is simply playing the market. Other dealers, responsible dealers tell me that it's a very illiquid market. Many people are on leave. So this bit of up and down will happen. But no one's really worried that there will be rate action on November 3rd.
All right, Lata Venkatesh, thanks so much for getting us those details and clearing the air on the fears of an unscheduled rate hike. It is unlikely focus could be on the inflation report. Moving on then, the European Central Bank announced a 75 basis points hike and the third consecutive rate hike this year. Now taking deposit rates to 1.5%, which is, remember, the highest level since the year 2009 that they have seen. Now the ECB in a statement also said that it expects to raise the interest rates further to ensure the timely return of inflation to the medium-term target of 2%. CNBC's Jomana gets us the full report.
Let's just start with the main announcement, a hike of 75 basis points. To be honest, it was pretty well telegraphed that they were going to go ahead and do that. They'd been talking about market expectations into the meeting and pretty much affirmed what the market had been pricing in. Its second 75 basis point hike back-to-back, taking the deposit rate to 1.5 percentage points and the total amount of hikes in this hiking cycle to 200 basis points. Now, for anyone who was looking for an announcement on QT, a possible reduction of the balance sheet when it comes to the bonds sitting on the balance sheet, well, that did not happen yesterday. However, President Lagarde did allude to a decision being made come December. There was a modification in some of the language, however, specifically because the ECB did hint at further rate hikes to come, but dropped the reference to the next several meetings. They also did say that substantial progress had been made on withdrawing some of the monetary accommodations. So those couple of lines that were included were taken to be quite dovish. I just want to mention as well that they did make an announcement on the TLTRO funding. This is something that we had been talking about a carry arbitrage opportunity that opened up for the European banks. They're now tweaking the terms of the funding rate so that banks will no longer enjoy that carry opportunity as of November 23rd. But as for the rate outlook, during the press conference, I asked Christine Lagarde whether future hikes could actually be smaller, given we're approaching 2%, which is what they have signaled to be the neutral rate in the past. Let's take a listen.
It's a significant rate increase, 75 basis points, twice in a row. And we decided to do that in order to pursue the substantial progress that we have to make in order to withdraw monetary policy accommodation. Our sense is that we have already made significant progress. As I said, we are not done yet. There is more ground to cover. And the question of what pace will be, or what will be the magnitude of future rates will be determined meeting by meeting.
All right, that is the latest from the ECB. But staying with some more central bank action, the Bank of Japan has also left interest rates unchanged at minus 0.1%, while also maintaining a dovish stance, quite in contrast to global central banks that are on a hiking spree. Now, inflation projections were also raised, with the core consumer inflation now projected to reach 2.9%, that is for the current fiscal, compared to the previous forecast of 2.3%. Now, citing the basis for the dovish stance, the bank has also said that underlying inflation would heighten long-term inflation projections, something which would, of course, lead to sustained price rises, which would be accompanied by wage gains.
All right, and the US economy, that recovered sharply in the third quarter, posting its first period of positive growth in 2022. In fact, the gross domestic product, or the GDP, rebounded at 2.6% versus an estimate of 2.3%. So it did beat the estimates, and that created a little bit of euphoria. So what is the Fed likely to do now? In fact, Brian, the CEO at Bank of America, tells CNBC that the Fed is likely to raise rates by 75 and 50 basis points in the coming couple of quarters. And he also weighed in on the disappointing earnings from US big tech companies. Let's listen into what he has to say on all of this and the macros going forward.
Our experts have them raising 75, 50 in a couple quarters, which is consistent with what you just said, in that they've raised the rate, it gets up near 5%, and then they have to let it work. And you're starting to see it work a hair. I mean, a little bit here. You're starting to see, the instantaneous transmission to housing in the U.S., the instantaneous transmission to the financing cost of cars and things. But you still see strong consumer spending, and that's going to be one of the things that's tricky here, because the U.S. is a consumer-led economy, and consumers continue to spend. Well, I think the answer is, when growth slows, you got to be able to manage your costs well. So in our company, when the team took over in 2010, we had almost $75 billion of costs. We run the company on 60 today, 13 years later. And that dynamic comes because you get slower growth in a mature industry like banking, and you got to manage the cost revenue dynamic. And I think that's the message the market's sending out broadly, which is we need to manage profitability as opposed to straight growth heading into potential recessionary environment.
All right, that is the word from Bank of America on the Fed's likely move from here on. But with that, we're going to get into a short break for now. But up next, Elon Musk has taken over as Twitter head. More on that very interesting story when we come back.
Welcome back. You're watching Business Lunch. A quick look at the market. And yes, some of the banking stocks, especially Kotak Mahindra Bank, has shown immense amount of strength, and that has stabilized or at least abated the losses on Bank Nifty. So from almost 1% down in trade, it has gained some bit of ground. Reliance Industries is another big player, which has given a lot of momentum and strength overall to the market for Nifty to stay in the green at the moment. But the big talking point of the day and the important story then, Elon Musk is now finally in charge of Twitter. And in his first tweet since the takeover, Musk wrote, "The bird is freed," in an apparent reference to the deal closing. Now, CNBC learns from sources that CEO Parag Agrawal and finance chief Ned Segal have exited the company's San Francisco headquarters and also will not be returning now. Now, question now remains how the social media platform is set to look under the Tesla chief Elon Musk, and calls himself a free speech absolutist. And also on that front, there are concerns around him beginning banned accounts back into the play. Time and again, Musk has voiced that he wants to turn the social media platform into an everything app, including payments. To add some more context for our viewers, well, Twitter shares will be suspended on the New York Stock Exchange today and from the S&P 500 on Tuesday. And the stock has surged more than 25% this year after Musk proposed the sale price of $55.2 per share back in April for this particular deal. So quite a frenzy on that account, Pavitra.
In true Elon Musk style, right? Like you wouldn't expect a regular turn of events, but that's
He's a showman. And this is a historic event in media and communications and social media business.
All right, that is the latest on the Twitter takeover. And with that, we are going to wind down on this edition of Business Lunch. From Nisha, me, and the entire team, thank you very much for tuning in. Mid-Cap Radar after this short break.